Artificial intelligence is everywhere right now. Headlines, earnings calls, social media. It feels like every company is either building AI or claiming to use it. For investors, this creates a dangerous mix of excitement and confusion. While AI is one of the most important economic shifts of our time, most people are looking in the wrong places. They're chasing the obvious. They're buying what's already gone up. They're reacting to headlines instead of understanding the structure behind the movement. And in doing so, they're missing where the real money is actually flowing. To understand AI investing in 2026, you need to stop thinking in terms of hot stocks and start thinking in terms of layers. AI isn't a single industry, it's a system. Value is created at different levels. At a high level, the AI ecosystem can be broken into three main layers: infrastructure, hardware, and compute, platforms, models, and cloud services, applications, end user tools, and products. Most investors focus on the top layer, the apps. These are the most visible: chatbots, productivity tools, AI content generators. They're exciting and constantly in the news. But historically, the biggest wealth creation happens lower in the stack. Every AI model, no matter how advanced, runs on hardware. This includes GPUs and specialized chips, data centers, and energy infrastructure. Companies like NVIDIA have become dominant because they control the tools that power the entire ecosystem. Every company building AI needs compute, and that demand has exploded. But here's what most people miss. It's not just chips. AI requires huge amounts of electricity, cooling systems for data centers, and physical infrastructure to support scaling. The AI boom is not just a tech story, it's an industrial story. Investors who understand this watch energy providers, data center REITs, and infrastructure plays. This is where long-term durable value often sits. The next layer is where AI models live. These are the platforms that build and host the intelligence itself. Think cloud providers, model developers, and enterprise AI systems. Companies like Microsoft and Google combine infrastructure, data, and distribution. They don't just build AI, they control how it's accessed. This creates a powerful position. They can monetize usage, integrate AI into products, and lock users into ecosystems. However, this layer is more competitive and margins can compress. Still, this is where some of the largest companies reinforce their dominance. This is where most retail investors focus. AI apps include writing tools, design tools, automation platforms, and customer service bots. These are exciting, and some will succeed, but many will not. The barrier to entry is lower, new competitors can emerge quickly, and features can be copied. Users can switch between tools easily, inflating valuations and intensifying competition. That doesn't mean there's no opportunity, it just means the risk is higher. The biggest mistake right now is chasing visibility instead of structure. People see a company trending and assume it's a good investment. By the time something is obvious, it's often already priced in. Smart money doesn't chase hype. It positions early in the parts of the system that are hardest to replace. That's why infrastructure has been so powerful and why it may continue to be. AI doesn't just create value in tech. It creates ripple effects across the entire economy. More AI means more data centers and more energy demand. More automation changes labor markets. More efficiency puts pressure on traditional business models. This creates opportunities in places most investors aren't looking. Some areas to watch are energy producers, industrial suppliers, cybersecurity, and data infrastructure companies. These aren't always labeled as AI stocks, but they benefit directly from AI growth. That's where asymmetric opportunities often exist. Is AI overvalued right now? This is the question everyone is asking, and the answer is nuanced. Yes, parts of the AI market are overheated. Some companies are being valued BA,